have one extreme negative, one reassurance. How do you vote?
Well, I'm more positive, I think, than either Marty or Mary, in that I think that we've probably had 90% of the decline. I think it's possible we could go lower here over the next week or so, but I think sometime between now and maybe the end of the year or the end of the first quarter, that you'll see the market in excess of its recent highs.
What do you base that on? Why do you disagree with that?
Well, I would agree with Mary in that I think we're due for a rally in the bond market. And I think we will see some improvement in terms of the trade numbers as we go forward here. And corporate earnings, I think, are going to get better as we go forward also. So I think that interest rates probably are the key to the extent that through the first half of the year, or really through the first 9 months of the year up until recently, the bond market and the stock market had moved in an inverse relationship. Now I think you will see somewhat more coupling of the two, and I think that interest rates probably will rally sometime over the next several months, and I think we'll enjoy a nice recovery when that occurs.
Let's hope we're all still solvent when that occurs. In any event, panelists, it is time now to rush aid to the wounded and answer some questions from our viewers. Martin Zweig, Harold Roth of Beloit, Wisconsin, is curious about the huge volume of trading on Wall Street this year, as dramatized by today's record. He wonders if there are precise statistics available about the number of people who are participating as compared with the number of institutions and how much of the trading each group represents. In short, what is the impact of us little guys, and do we still have a chance?
Well, there's, say, 20 to 30 million of little guys, but a lot of them aren't that active. There's thousands of institutions, but the institutions do roughly 43% of the share volume on the exchange, and the public does about 30%, and members do the rest. In dollar numbers, though, the institutions would have about a 2-to-1 lead because the public tends to buy lower-priced stocks. On the Amex, the public does more than double what the institutions do, but the institutions have more impact now than the public overall.
All righty, Mary Farrell. Charles Collins of Shreveport, Louisiana, like a lot of other people tonight, is a self-confessed nervous Nelly in what he calls this gyrating market. He's begun to worry even about the possible effect of a crash on his money market mutual funds. How safe are they? How vulnerable is he to a possible catastrophe?
Generally speaking, money market mutual funds are a very safe place to be, and I'm sure there's a lot of people on Wall Street wish they had a little more money in them after a day like today or a week like this week. They're safe for two reasons. One is they have a short maturity, very short term, usually on average about 45 days. And secondly, they're very high quality. Some invest solely in government securities. Usually it's AAA or at least AA rated. But his real safety factor is to read the prospectus, to be assured on both them where they will clearly state the maturity and credit limitations. And generally speaking, even a collapse of the stock market should have no effect on the money market funds.
All righty. Lou Holland, how would you respond to Sidney Bauer of Seguin, Texas, who writes as follows? There's every indication that in 1988, regular gasoline containing lead will probably become an obsolete commodity. Many older trucks and cars, plus much industrial and farm equipment, still require regular leaded gasoline, or engine damage will result. Can you suggest stock investments that might be good for someone wanting to profit from the additives that will be sold to compensate for the absence of lead in fuels for use in these engines?
Well, Mr. Bauer, you're quite right. In 1988, it will be more difficult to find leaded gasoline. However, I think you should consider investments in areas that have some growth potential. And to the extent that most vehicles now really are adaptable to unleaded gasoline, it's not a very large market. But I guess there is one company, Lubrizol, that does have an additive or an octane enhancer, I would say, that might be something that you could play.
Mm-hmm. All right. Now, if you would like to get the lead out of your investments, it'd be a gas if you'd give me a chance to pump our panelists. So send us your highest octane money questions here at Wall Street Week, Owings Mills, Maryland 21117. That's Wall Street Week, Owings Mills, Maryland 21117. And step on it. Now, before we meet tonight's special guest, let's take a look at an area that lately has become to him and many other experts a matter of interest and concern. For starters, let's follow the trail of short-term yields, as tracked here by those on 90-day U.S. Treasury bills since January 1985. After topping out above 8.5% in March of that year, T-bill yields went on a pretty steady decline, dipping to a low of 5.18% 1 year ago this month. Then the trend went back on the rise, with T-bill yields today at 6.8%. Meanwhile, municipal bonds, with their inviting federally tax-free returns, have lost some of their investor appeal with the recent changes in the tax laws. Munis peaked in March '85 above 9.75%, then dropped as low as 6.6% in January and February of this year, before climbing back to today's 9.45% yield. Yields on long-term U.S. government bonds, following the pattern of the T-bills and munis, reached their recent high in March '85 at more than 11.75%. The rates dropped consistently after that, hitting a low of 7.6% last January. But T-bond yields today are all the way back to 10.17%. Is all the good news about lower interest rates now behind us? And what does that mean for the economy and the financial markets? For some thoughts on that, let's go over now and meet tonight's special guest, Allen Sinai. Allen, welcome.
Hello, Lou.
Please. Allen Sinai's financial forecasts span the globe and delve into just about every nook and cranny on Wall Street. He spent a dozen years at Data Resources, co-developing its renowned models of the U.S. economy with the late Otto Eckstein, an old friend of this program. In 1983, Dr. Sinai joined Shearson Lehman Brothers, where he is currently the chief economist and a managing director. Allen, what sort of signals does a week like this past one send to your forecasts?
They're very serious. The signs and the symptoms that the financial markets are giving off are of a very bad problem for our markets and our economy, and have to make me much more worried about the economy for next year.
Have you changed your economic forecast as a result of this week's action?
Well, you know, the extraordinary levels of interest rates, even at these rates of inflation, and the tremendous decline in the stock market are symptoms of both huge budget and trade deficits, tremendous amount of financing, and no one can say for sure how high interest rates have to go in order for that to occur. And the result of this much problem on interest rates, 3 percentage points higher this year, and of the big declines in the stock market, have to be much more damage to our economy and raise the risks of a recession next year.
Give us a forecast for each of those three interest rates we just saw. What do you expect to happen to T-bills, munis, T-bonds?
Well, over the next 2 or 3 weeks...
Well, over the next year.
Over the next year, on average, they should move higher. We are later in the stage of the business expansion, and we should see long bonds, and there will be respites, there will be some periods of improvement, but between now and then, another point and a half on long-term interest rates, with much higher short-term rates in the interim.
You quite recently said you didn't expect a recession next year, and now you're raising that specter. At what point next year, and what odds do you give it?
Well, up to now, at least until April of this year, I thought the odds were 1 in 10 of a recession before the end of 1988. Starting in April, I thought those odds were 1 in 4. And now I'd have to say that there's a 1 in 3 chance. The odds are still good that we'll get through it, get through 88 into 89, but the risks are growing almost by the day. And 89 looks more risky, even than 88.
What could we do to avoid the forecast you've just made coming true?
Well, at a certain stage in the business expansion, there's only one forecast on interest rates. On average, they have to move higher regularly as inflation moves higher and as the business cycle moves to, business expansion moves to an end. And the only way to avoid that is through a major slowdown or a recession. The only other way is for inflation rates to go a lot lower than 4 to 5%, back to 3 to 4%. Another possibility would be a breakthrough in the budget deficit, more than Washington has done on the Graham-Rudman-Hollings fix, substantial improvement in the trade deficit, much weaker economies overseas, or interest rate relief from overseas. If you run through each of those, right now, none of them look very probable.
What does that suggest for investors?
Well,